Good evening, ladies and gentlemen. Today is the 23rd of September and the weekly expiry after having a tremendous amount of volatility during the week and a steady rise in India VIX as well. Today, after the FOMC meet, you would have thought longer dated options would cool off a little bit. Hasn't really been the case. There hasn't been much of a fall off in later dated options, and just because we are now at the lifetime high again, and the tremendous short covering that took place to pull us here. The later dated option continue to remain quite high, and yeah, will be interesting to see till where we rise if India VIX continues to rise before finally falling off. So all that being said and done, today was a day where Nifty moved more than 1.5%. Bank Nifty moved like 2.25%, and it was just a steady one-way move with almost no pulling back, nothing, just steady one-way move. And that would have been all right, but at the higher ranges, I was definitely biased towards there being some kind of profit booking or some kind of like consolidation, at least before we break through. We cut through maximum open interest like it was absolutely nothing. Tremendous short covering, and to that short covering, a lot of slippage as well. So multiple times I got burnt by calls. Again, it's the same strike that ended up burning me. I was also a little bit, definitely, I got a little frustrated. I didn't let it affect my trade as such, but yeah, definitely I was on the frustrated side. And towards the end, I think I got really adventurous by trying to straddle into averaging, but that did not work out so well because I had to cut out of the entire call side leg, and by the time I was able to get out, I gave up quite a bit. So all that's said and done, this could have been a tricky expiry, but even then, I wouldn't think it was one of the hardest expiries just because I didn't do so well. Doesn't mean it was a terribly hard expiry. It was one direction, so it was not that difficult. But it could have been tricky, especially because there was heavy consensus that 17,800 most likely would act as a top for today's closing. All that being said and done, I hope you had a good trading day. I hope you didn't get stuck up in any positions, and I will catch you tomorrow. Also, some of my covered calls position, despite the adjustments now with the kind of up move today, are starting to hurt a little bit. So I've done a little bit of management there. But I don't have to be overly concerned about them because there is a proportional gain and a much more gain in my holdings than what my current positions are losing, even though they are kind of making money, but ideally I would want to capitalize on those positions a little better. Thank you so much for watching. I hope you had a good expiry. I will catch you tomorrow.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Okay, just realized that every clip I've recorded so far, it was on face cam, so there's nothing visible on my screen. So they're basically useless. I will go over what has happened so far. So we opened gap up, and I was expecting 17,700 to hold as a resistance, and with the tremendous amount of put writing at 17,600 and above, I was expecting a range of 17,700 and 17,600, but very quickly, like butter, we cut through 17,700, and to manage that, I had to initially, my first entry was at the 17,500 and 17,800 position, but as we started heading higher, I moved up my puts by 2 strikes to 17,600, and my calls down by 1 strike to 17,750. Now very quickly, the 17,750 from my entry price, which was around under 10 at that point of time, which is under 10 at that point of time, about 9.8, it started to expand quite rapidly till about 16, 17, 18, at which point I moved up my puts from 17,600 to 17,650, because this also was trading at about 16, 17 at that point of time. Now, as we headed higher, I tried to wait and find a little bit of liquidity to get out of the 17,750 call and roll it to 17,800. But at the same time, I also exited the 17,650 put. So basically, I took a 100-point strangle and made it a 200-point strangle once my call strike was about 20 points away. And unfortunately, I had to do it with quite a bit of slippage because you see, I wanted to execute the order when the price was about 1920, but I ended up getting a price of 22.23 at that point of time. So around 10:13. Let me just show you. Yeah, here. So wanted to get it at around 1920, but as I was executing, got some pretty bad slippage there, but that's okay. I also got it all right, acceptable entry price on the 17,800 call short. So as of now, on my position, I'm about 1.5 points down, and yeah, that's fine considering that we've had quite a stiff up move right off the open. As of now, the 17,700 straddle is pricing in about 60 points in either direction, and I'm sitting on a 200 point triangle. So the same time I moved my calls away, I also moved my put options away, because in case from that stiff up move we had a pullback to 17,700, that would expand the puts and my call would not have enough premium to compensate for it. So just in general, taking risk off on the entire position as in when we were making that up move. Now with 60 points in the at the money straddle and me currently sitting on a 200 point triangle, that gives me a very high probability that I will not even be pushed to make any adjustments on this as such, given that my short position has a little under 15 rupees and my hedges have about 3. That gives me about 12 points on 30,000 sizing. That should be quite comfortable. Now it'll depend once again on if there are some kind of big IV spikes, like for example if we test and break 17,750 on the upside, which is 30 points away, then I will use that as an opportunity to take credit from the 17,650 put option. Otherwise won't do much. If we break 17,700 down and make a 20 point move to basically 17,680, the point from which we had this breakout move around here, right? So 20 points below, then I will once again take the credit from this 17,750 call. So unless such an opportunity presents itself, I don't see myself doing anything. I would more or less be holding on to this position probably towards the last part. Once hedges have pulled off, I will bring in my hedges and try to increase my sizing and benefit a little bit more. But apart from that, really not much. With 60 points in the 17,700 straddle, I think this position for now is perfectly all right. One more thing to note, hedges are ridiculously expensive. After we made that up move, obviously when I say obviously, it's counterintuitive, but there's a tremendous rise in the 17,000 put option. How does that make sense? It's because people are aggressively writing put options at 17,700, 650, 600, some all the way up to 17,800. So to hedge that, they will do a tremendous amount of buying of these super OTM puts, one for the margin benefit and two also for doing hero hedging. Like if you're shorting one in the money put option, maybe they buy 2 or 3 OTM hedges, one that gives you more margin benefit, and in case there is some kind of a complete cascade, you would require 700 points. But I think 700 points where this put option is trading at, it was trading at 2.5 rupees. I'm not even joking. Just like, wait, we can see here. Yeah, like 2.25, 700 points away. So all that being considered, for now, nothing to do. My only criteria will be if we start testing 17,750 on the upside or 17,680 on the downside, then I'll see what needs to be done. So the time is 10:40. As of now, I am a little more than 1.5 points down, but that's very much all right. Okay, something else to note is my Reliance position. Currently, this particular trade is giving me a good 2.6% return. My shares also obviously have benefited immensely. This started off as a covered call. Cover itself is giving me a 1.5 lakhs loss, but the position all put together is giving me a 87,000 profit. So despite the call going in the money, now finally this is. Now there are two things. Reliance, first of all, let me show you, is potentially in the territory where it can break out and make a new lifetime high, right? So in this particular resistance, we've already gapped up and over, and we head here, you could have some kind of a big breakout and continuation on Reliance. Now that can be problematic because this position has a negative delta, the position itself. Let's forget the fact that we're holding shares. Now I have one option, which is to book this position towards today's close, because in case there's a gap up tomorrow, then that is then going to really hurt my position unnecessarily. From here, just about another 30 points or so, so a little more than 1% of a move will actually wipe off any and all profits I have on this position. So I have two options. One is to book this trade, and the other is to add an in the money short straddle of 3 lots where my put is in the money. So I will be getting good credit for that, and that will reduce my lower break even. It'll move it up to 2300, but at the same time, in case there is a continued up move, it extends my upper break even by an additional 10 points and gives me a flatter payoff curve in this particular zone. So this is two things that I'm considering. Now, depending on how we're closing today, by the close, I will have to make that decision as to whether I should book this position and basically book this position and sell next month's call option as another fresh covered call on Reliance. So where would I sell that? At roughly 2600 is where I would sell it. Let's see how much is Reliance. Check 2600 call option for the month of October. This today being a green day, this has also gained. I'm getting good 50 rupees for it. So a good chance that what I'll end up doing is booking the position and selling this for a good 50 rupees. So yes, we'll keep you posted. Time is 11:13 and as of now my position, that's basically the idea. The at the money straddle is trading at 60 rupees, not pricing in much risk. Up move is not really expanding the 17,750 call option anymore. So it's not really gaining, it's not creating any fear to cover at this point of time. So then this position basically should more or less be headacheless. And yeah, we'll keep you posted. As of now, as far as the open interest is concerned, very strong building of that 17,700 straddle and sideways positions around 17,700, 17,750. We'll have to keep in mind that there are already existing positions at lower levels, which would have been covered in futures in Singapore last night, this morning, as well as all the put option writing that took place right at the open. So I don't think anybody would particularly be stuck at this point of time. And with now maximum put side open interest being 17,700 and call side open interest being 17,800 with the considerable call build up at 17,750, most likely range that the market would be projecting is 17,700 to 17,750. So we'll keep you posted. Currently that 17,700, 17,750 is trading, if I'm not wrong, for something around 40 rupees. Yeah, 40 rupees is what that particular 50-point range is trading for. So we can keep 17,800 as the upside limit and 17,650 is the downside limit. We'll keep you posted. Time is 11:15 and as of now it's almost like nothing happened so far. Okay, we had a stiff up move and okay, we have continued up move, and what I've done is I have just about moved my puts up now. Around 11:30 is when 17,700 put option became maximum open interest, and tremendous amount of writing of 17,700 and 17,750. Because of that, so the hedges are not giving up any value and have been consistently gaining actually at different points, because a lot of buying of super OTM hedges to get that hedging benefit and write those put options. As of now, the 17,750 straddle is trading for a little bit more than 50 rupees. So 55 rupees is what it's trading at. 17,800 is maximum call side open interest. 17,700 is maximum put side open interest. I don't want to short the 17,700 because with that kind of put writing that's happened since morning to such a tremendous extent, I don't want to deal with the fact that a dip of 20-30 points can see spooking out of those people. So I waited for the longest time to move up my put to 17,650. And now that it is very clearly confirmed that already the market has positioned itself quite firmly around 17,700 put option itself most likely being worthless, then I'm okay shorting the 17,650 put option. So that is more or less where things stand at this point. And my short position has under 14 points, slightly 13 and a half. My hedge still has about 3 points in it, slightly less than 3. So the position, I'm not really going to do much more to it at this point. I would ideally have wanted the hedges to give up some value so that I could have ideally moved up my hedge. I mean, best case scenario, my hedge should be at 17,500 right now if it was trading at something like 1.5, but instead it's trading at 3.5. So I'm not going to be increasing my sizing just because I can gain a little bit more if I have to pay through the nose for these hedges. Like, I would be paying half the credit on my short put by buying this long put. So I will not be doing that. Yeah, all that said and done, time is 12:08, and as things stand, we are holding consistently at the high levels. And let's see if Max Nifty makes an up move here and takes out 37,700. But yeah, very, very bullish overall data. And one more interesting thing is that there hasn't really been much of fall off in India VIX, even post the FOMC meeting. What I'm thinking of doing is in this VIX range above 15, small sizing, so roughly about maybe 5 to 10% of my margin available. I will take a strangle overnight, and I think the risk reward on that is pretty good at these current IV levels. So I'll see towards the close how the position is looking, and accordingly I will see if there's something that I'm going to be carrying. So as we take out 17,750, a little bit of an expansion on this. I'm fine though. I can let this expand till about 10-11 before I then start considering taking the 17,700 put option credit. I will not be in any kind of rush to do that. Okay, waited for the appropriate spike in IV, and what I've done is moved up all of my put options to 17,700 because now we're firmly holding over 17,750, and that has led to a considerable short covering of lower level calls. Also, very clearly now, the 17,700 put option is by far the maximum open interest, and I don't expect us to be breaking that at close. So my position is now back to being a 100-point strangle of 17,700 and 17,800. And in case this starts to expand to 15, effectively my short position has about 20 points in it. If either leg expands to 15, I will then manage risk by taking risk off in that leg. So if this particular leg expands to 15, I will square this off and actually sell the 17,850 without doing anything with this put option. So now that both my legs are on the maximum open interest, I do not want to then move in further closer, at least not till we have about 45 minutes, 1 hour left to go for expiry. So yeah, that up move expanded these calls. Clearly the 17,750 straddle is pricing in about 50 points in either direction. It is actually gained now, so no, about 52 points in either direction, and that 50 points on the upside and 50 points on the downside is where I currently am. I had to bring in my hedge closer as well, so I moved it up by 300 points. The difference I had to pay was about 60 paisa, and that's fine. So now I'm sitting on the maximum open interest, and ideally if I can maybe consolidate here for a while for the next hour or so, this position should benefit quite a lot before I have to risk off in either direction. So the best case scenario is, in case we do test 17,800 on the upside or 17,700 on the downside, ideally we hold here for a while before we test, so that I can get enough of a fall off in the premium of the spread itself. Yeah, we're just about halfway, heading to 12:30, and we continue to trade at the day's high. Bank Nifty continues to show an immense amount of strength. Not much happening from IT or lines. A little bit of an IV spike where both the put option and the call option have gained. Put option went down till about 7 points at one point, and as the call option started expanding, the put option is also expanding. Which means basically people are in a rush to somehow get out of both sides. So people probably taking the exit on both sides. And the strangle value itself has gained, now putting it at around 22. And more or less my idea remains the same. If this expands, I'll let it expand to 15. If it goes to 15, I will take half of this and move it to 17,850, which for all practical purposes can be considered definitely dead in the water. But we'll have to wait and see. As of now, we are more or less holding just 15 points above 17,750, so it's not a particular cause for concern. Here's the thing, now if you look at later dated options, they're actually going up in price. India VIX, despite the FOMC meet, is actually up today, despite the meet having concluded and despite having the initial dip getting bought back. So all that considered, at right now, I kind of know at which point I will be adjusting this trade, so I'm just sitting in it. There's a little bit of pain, and yeah, we'll have to just ride through it. So I will not be moving up my put option to 17,750. The rate at which puts have been written into this entire up move would be a really dumb idea to now join in on that party. The reversal risk is too high. Yes, if this expands, I will lose 2 points and another 2.5, 3 points here, but that's okay. You have to kind of take that risk in order to sit in a position. If I too preemptively move my calls away to 17,850, which are trading for 3.5 points, so I have to know for a fact that this 17,700 put is dead for me to take that kind of a trade, because in case there's a reversal after the steady up move, in case there's just a 30-40 point down move, this put is going to be close to doubling. It will reach 15. So I cannot afford to take risk off on the calls until then. Yes, all this being a consideration, one issue for me now is that Reliance continues to head higher. So my Reliance position is not going to look so hot. And if it closes somewhere close to this new all-time high situation on Reliance, then basically the IV will also spike and I will not get the best profit to book on this. But it also means that when I'll be rolling forward my covered call to the next month, that will be at a pretty good premium. When I saw it, it was at 50. It is still at 50 only. Okay, we'll keep you posted. As of now, the IV is gaining. So despite the down move and the calls cooling off, the puts are effectively gaining more than where I was at in this position when we were at 17,750. So keep you posted. Time is 12:30. We're exactly halfway, and so far it has been a one-way move. Nifty being up 1.25%. Into that, what I had to do is quickly move my puts up to 17,750 because this was expanding to 1617. And currently what I've done is I have a 50-point strangle and I have an exit criteria on this at about 23.24. It's quite aggressive, but that's been the kind of nature of today. If I risk off too early on the put, then I always have the threat of this call once again exploding and me getting absolutely no credit for the 17,850 call option. So yeah, I had to basically take a hit of a good 2 to 3 points in order to move up my put. And more or less, this now works with the expectation that we will expire either just below 17,800 or at 17,750 and above. Problem would be in case there's a big reversal in this put gains. So I'm going to keep a 5-point buffer, which is quite up there in terms of how much of a buffer I'm keeping. But I will have to do that to not get faked out into any kind of dips. So yeah, this is a very high risk to reward position, and I will ideally be able to hold on to it for long enough to get some kind of a fall off before then having to risk off in either direction. We'll keep you posted. Time is 12:45 and currently sitting on a 50-point strangle and had to move up my hedges as well. So moved the put to 17,500 and call side hedge is exactly where it is. Okay, so a little bit of selling in Reliance after it was just about testing 2,500 and red candle on IT as well. That is pulling us back towards 17,750, and what I've done is half my quantity of puts. I've squared them off at 17,750 and rolled them down back to 17,700. If this expands, I did that about at a price of 20 change, 1920. Yeah, 20. And yeah, the moment this goes to 21, 22, at that point, I will additionally square off another 50% of this and move 75% of my puts down. So it's kind of like this. There's about 12 points of credit in all of my calls. So between my two put strikes, roughly, if you see how much credit I have, it will be the weighted average of these two, which is roughly 50-50 also you assume, and comes to about 12. So that is more or less the idea. I don't want to be sitting on these puts as they explode too much, which is why the whole idea of taking risk off. So when would I once again move all of these put options back to 17,750? If in case this call option starts expanding to about 17-18, what this is currently trading at, then I would assume this would have fallen below 5, and this also should be trading at something like 12-13. It's like a swap of prices from here to here. I will move up the remainder of these puts here. Otherwise, in case this expands to 22-23, square it off and move it down. So yeah, it has been one-way expiry. Finally, looking like at least we'll hold around in this range, but we'll have to wait and see. It has been quite tricky when it's just, despite there being tremendous open interest on the call side, all of that is getting completely negated. Okay, we're slowly seeing that expansion. The call isn't particularly giving up too much, but I'm going to switch it in such a way that almost 70% of my position is now at 17,700 put short, and yeah, just a little bit more than 1/4 is at 17,750. We're just 10 points away from 17,750, and there will be, the reason these puts won't expand too quickly is because people expect that there will be buying on the dip. That's why the puts are not expanding as quickly. Okay, we're reaching 23, and that is going to be the last of it. Okay, so I'm more or less happy with how that went and the execution of that. I think I got out at the right time, just as it is going at the money. I have squared it off and I have rolled it down to 17,700. So I'm back to being on 77 and 17,800. There is, you can see that in the past 30 minutes, there has been a little bit of unwinding from almost 1 crore to now it's reduced by about 5%. The put open interest at 17,700 and the 17,800 call open interest has actually gone up from about gone up by 10 lakhs from 75 lakh to 85 lakh. So now we're back in that situation where we are strangling 100 points, which is maximum open interest, and we have actually dipped below 17,750. Since there is put side max OI at 17,700, I would think most likely this would be protected by close. But in the interim, since there's such a large open interest, we might see a dip till 17,700 potentially. It's very much possible on the cards that we see a dip like that, and into that dip, people get pushed out of here, and then we see a buying back. Roughly, this short position now trading for 16. My long position still has 3.5 points in it. This it's like absolutely ridiculous. You can't even move in your hedges closer because they're so expensive. And if this expands, I would say to about 13, 14, which was a previous swing high for it, then I will square that off and roll it over to, I think 13, 14 would be too close. About 15 is when I would definitively roll out of this and roll to the 17,650 put. But you can see, despite me having moved up my puts and having it rolled away at the same price, just the crash in call side fear that now that people are seeing, okay, that we didn't push beyond that. Reliance took resistance at 2,500. Bank Nifty took resistance around that 37,800 mark. Complete crash in that call side has actually benefited my position to an extent where, as of now, I am just down a little more than 2 points. So a lot to be paid for hedging. Hedging is very expensive, no doubt about it. Okay, what a complete pain. Made a swing low and immediately in 2 candles have head back to the day's high, just as I took risk off on this put option. And it would be unrealistic to expect that I could have held on to this put option also when it expanded to about 26, 27. And very quickly that up move has completely smashed the prices of the put option. And now, once again, my call is at threat of getting covered to a large extent. What had crashed to almost under 6 is now doubled. And yeah, the up move is coming from Bank Nifty, making a new day's high. What will be my approach now? Very simple. Once again, same logic. Let this expand to 15. If it expands to 15, at that point, my trade for the day is done. I'll square this off, move it to 17,850. And at 17,850, can more or less assume that that is going to end worthless. And in case in the last 30 minutes of the expiry, there is an opportunity available to take credit either from the 17,750 put or the 17,800 call, I will be moving into that particular position. That's the thing. So even if you have the data, even if you expect a certain situation to play out, you're expecting there can be potentially the dip getting bought. So there's weakness 1, 2, 3, 4, 5. 5 candles of slowly dipping to where maximum straddle positions of 17,750 are, and you would expect that you would hold around there for a bit, but no, immediately 2 candles, entire dip gets bought. And yeah, I mean, what I could have potentially done is into the down move, sell the 17,750 call, and then on the reversal, once again square off that call and move it up, leave all of my puts at 17,700. That would have been one approach, but that would have little bit compounded my risk. If I was already sitting in a good profit by now, then that is a potential consideration. Since I'm not sitting in a profit and I'm actually down about 4 points, it doesn't make sense for me to do that. Regardless, we are now at the day's high. We'll have to wait and watch now if
the particular 17,800 level gets defended, or once again there is short covering that will take us further up. So we'll keep you posted. Time is 1:30 and it has definitely not been an easy expiry. The thing is, you always expect some kind of pullback to happen at some point and then consolidation. But the pullback is short, fast, and then immediately you're back. It can be quite problematic. We'll keep you posted. The time is 1:30. Also to note though, this particular move had one more impact. So after this dip and this immediate buyback in 2 candles, all the hedges have lost a lot of value. So very quickly, this particular hedge has crashed. This hedge is obviously losing me 50,000. This hedge is losing me 14,000. This particular hedge lost me 18,000. So far, even if I were to square off now, just my cost of hedging has been around 80,000 plus, and that itself is a huge cost. And furthermore, I'm going to have to pay another almost 2.5 rupees. So 2.5 rupees is 1 lakh. I'm going to have to pay another lakh in hedging costs just to be in this position. Not the best thing ever. All right. What I'm going to do is I will roll about 40% of these calls up, just to not to have to deal with the headache in case there is a call side explosion that takes place now. Okay, enough of this. I'm done having to deal with this. We'll take complete risk off on the position and later we'll see, because we're trading at the day's high and there's no credit left in my put option to give up, even if that were to happen. So half of my position I've removed from 17,800 to 17,850, where one can assume that the 2 points of credit in this should more or less be safe. And meanwhile, this particular call option, I'm going to leave 50% here, and in case we make a down move, test 17,750 again, then I will move down my calls again to 17,800. This is just like avoiding headaches, because I mean, it is very possible, even though the market is not accepting, that we now make enough move and close over 17,800 at a new lifetime high. Now, in that situation, do I have any credit left on my put option? No. The first time I tried to play it by moving my puts up to 17,750. That has backfired a little bit, and now there is not that much credit left in that position, wherein I again move my puts up. So instead, I will take the risk off approach. Okay, for one more time, we are now back at the day's high, and what I've done is at about 9 rupees, I've moved up my puts to 17,750 again. So I have basically 60% of my position at not 60%, more than 60% of my position at 17,750 and 17,800, which looks to be a good range at this point of time. This particular spread is trading at 16, thereabout, 16, between 16 to 17. And my idea is that for whatever reason the spread expands to 20, then whichever side is losing, take risk off in that direction and move further away. And this has been relatively tricky to manage, but however, with the reversal, calls not expanding too much, the puts have absolutely got smashed, and the level to which the 17,750 put has been written at this point, I would think it is most likely going to expire worthless, 17,750, which is why I have, even though at a bad price, but also all that time of risk mitigated. I mean, you can technically say my previous position was exactly this, and for a much better price, actually 10 points more than what it is now. But I also mitigated that time risk, wherein something could have happened. Now, with just 50 minutes to go for averaging is very different from when there was 2 hours, 3 hours to go for averaging. So once again, the same funda. I've moved in closer now on the put side and the call side. Call side anyway, about 50% of the position was here, just moved about 8,000 quantity from here to here. So yeah, this is the plan more or less, and once again seems to be like one of those expiries where until the end you really have to work hard. It's never an easy expiry, it doesn't matter. I mean, what this call option, even if someone had thought, okay, nothing else, if nothing else 17,800 will go to zero, unlikely that we test 17,800. You sell that at the open. I think it had a low of 3 rupees or something in the first 10 minutes, and that also you don't get for free anymore. You don't get those trades
where people can be like, okay, I will sell super cheap options and try to keep the credit. If you sit on it, it is going to burn you. It will take a lot of effort to manage to get out at the end of the day with some money. All that said and done, we'll keep you posted. Currently, the closest triangle trading for 16, and this widest triangle I can assume more or less is going to end up being worthless. Okay, once again, we are at the day's high. What I've done is into that, I have taken my 17,850 calls, moved them down, taken my 17,700 puts, moved them up, and created my entire position to now strangle 17,750, 17,800. It would take now, with the level of positions that have built up, something truly improbable for 17,800 to get taken out, which is why I'm comfortable with this call expanding till about 11-12 also. But currently, as far as my triangle is concerned, my put option really does not have much value anymore. And in case this particular call option does blow up, then I don't have any compensatory credit. So what I will have to do is I have to have a strict stop loss, but I'm going to give it some room. I'm going to give this room till 14.15, actually doubling from where it is currently, in order to get out of it. I will not be in a rush to do it, because in case I'm in a rush, I'll just get cheesed out, and nothing good of that is going to come. So in case this does expand to that particular value, I will roll it off, and at that point a consideration will also be taking in the 17,800 put credit. So if it gets to that, it gets to that, but we'll have to wait and watch. I'll keep you posted. We have 45 minutes to go for averaging, and as of now, once again, today broader market's so freaking strong, and this Larsen up move is really burning me. I mean, I have Larsen shares that cover my entire Larsen position to the upside, but somehow it does not matter. If there's a meme going on, if I take a covered call, if I cover my shares with a call option, it has to go in the money, and it has to give me trouble. Like this particular Larsen position now, I had created a very, very bullish structure, and considering the pricing of Larsen's options, you wouldn't think that kind of a move would just materialize out of nowhere. Of course, it means all of my shares have gained tremendously. I'm holding 1200 quantity of Larsen, and that 1200 quantity has gained a good 150 points. No, actually close to 200 points from my entry into this. So that is giving me a profit, but right now my F&O position is giving me a loss. I will most likely, what I will do here is I will create a little bit more buffer on the upside, and still try to come out of this position profitably. I'll see whether or not I should make any changes today. Since I have no upside risk, I'm not too worried about this position, but we'll see towards close what to do. Yeah, as of now, once again, we're holding at the day's high. Bank Nifty also trading at the day's high. Reliance is no longer making an up move, but the broader market is extremely strong. Everything tremendously in the green today. So anyway, I have to take that potential 5 to 6 points risk on this call option. Otherwise, I will get cheesed out of the position. Okay, that call expansion is happening, and we have now made a new day's high. And more or less, idea remains the same. Let it go to 15, no problem. I have credit between my put legs is about 3 rupees, so there's really nothing there that will protect me against this expanding. But more or less, this is a good risk reward to hold on to this call, because the moment I move my calls away to 17,850, there is really nothing more that I can gain from the call side. So that being the case, looks like that 15 price is going to get hit anytime soon. This 17,800 put option also gives me a good context in terms of how much risk is to be priced in on this call. And yeah, it has crashed from almost 27 to 18 in a matter of the last candle. So as of now, these are just 8 points out of the money, and I have about 2 points of room before I exit that, and at that point I will just be collecting this and whatever is remaining here, and I'll see if there is any more credit that can be taken as we head into averaging. So if the stop loss does get hit, then really can't do too much. Have to call it a day when you have to call it a day. Okay, that stop loss of 15 is hitting. Okay, got completely cheesed there. Try to start my exit. This is the problem with larger quantities. tried to start my exit on the 17,800 call option at 15 rupees. And you can see my first execution is, so technically the ticker read at that point 15, but the rate at which it exploded, by the time I was fully done getting out of it, I think towards the end I played close to 21, and yeah, so that is quite intense. But at the same time, I moved up my put option as well, because with not that kind of a breakout, the kind of covering that it would require tremendous shorting of 17,800 put option, and that is what has more or less salvaged my position. So I will just go over this particular option on a minute time frame. So my idea was to get out at 15, but same minute candle, you can see we have head all the way up to 20, and then up and away we go, right? So same time, obviously, I entered the 17,850 call short and moved up my puts to 17,800. So it's never an easy expiry. And with 20 minutes to go for averaging, we are now firmly trading above, not to a small extent. I waited for like a 15-point move before moving up my put options. We're firmly trading above 17,800. And my position at this point, what happens in the market is not so much so a concern to me as to looking at what my position, how my position will behave. Currently, my short position has a little under 10, just about 10 rupees in it, and my long options obviously have given up a lot of value over time, but currently have 1.3 rupees. So potentially somewhere around 9 points is what is in my position. If this expands to 12, I will further take risk off in whichever direction there is risk. So most likely the way it expands to 12 is if we have a pullback to 17,800, then this put option would gain. And at that point, I have to square this off and roll it back down. And then again, wait for an opportunity into averaging to see if there is any additional trade to be taken. Okay, so what I've done further, just to be a little more cautious of these put options expanding, is I've made a short straddle with 1/4 of my position roughly at 17,800. I've moved my calls back down, just about 11,200 quantity. I rolled them down so that whatever downside, if this put has to start facing, will be compensated by whatever these in the money calls will gain. So majority of my position is a triangle where 75% is a triangle of 17,800 and 17,850, and 1/4 my position is a short straddle at 17,800. So I think that would be relatively easier to manage and will give me less of a swing in a mark to market in case we head down and these puts start to gain. So currently these calls have an extrinsic value of 9 points versus these puts which have an extrinsic value of under 7. 15 minutes to go for averaging, and I'm expecting one of two things will happen at averaging. Either we will have like a flattish sort of a close, or we will pull back to 17,800 all the way till 17,800 and close at 17,800. So that's kind of what I'm working with at this point. Actually, if my position size wasn't so huge, what I would end up doing is moving my entire position to the 17,800 short straddle, because there is currently 30 points with 14 minutes to go for averaging, when there's the intrinsic value is just 12, and there is a very high probability, given how positions are built up, that we will close exactly at 17,800. So yeah, if my position wasn't as large and if I was trading a smaller sizing, then I would probably take that position. The reason I'm not doing it now is I've seen this last time. It becomes very difficult to get out of a position in case something starts to go wrong, because you have such huge exposure and it will always come at the cost of huge slippage. So those two things being considered, which is exactly why I cannot afford to do that on this position. At least if it is structured this way, I will have enough of a reaction time. 13 minutes to go for averaging, and as of now 2.5 points down, and should be closing all right unless there is a tremendous move below 17,800. Also, if we do end up taking out, once again, if we end up making a move above 17,825, goes without saying I will square off these calls and move them here. These calls have been moved down as a protection for the put options. The put options don't particularly need too much protection if we are 25 points away from them, at which point anyway my strangle position will be equidistant. So that is one more thing to consider, that this protection that has been bought by shorting in the money calls, even though only 1/4 the position, I can't afford to hold them into a 30-40 point move. Okay, I would think that point is more or less being achieved. Now the credit available in the put is far lesser than the credit available in the call. This call has not expanded much at all into this move. So I think the purpose of it has been solved. So time to get out of that particular position. Okay, now that there is 6 points left in this position, if either of these options expands to 5.5, I will be managing risk on them, either by squaring them off and rolling them away and then coming back, or by taking in credit. Depends on what kind of move is that, but I don't see myself taking additional credit in this situation. So 6 points potentially and 9 minutes to go for averaging. I think one thing that's high possibility is into averaging. We can have some kind of a stiff down move to 17,800, 20 points and kind of make this call expire worthless. Okay, 3 minutes to go for averaging, and we have had a pullback to 17,800. We are exactly at 17,800, but the call is trading at a tremendous premium to the put, a 10 rupee premium, which is huge. And what I've done is I have moved down half of my calls to 17,800, which have an intrinsic value of only 5 at this point of time, but have an extrinsic value of 12. So half of my calls have been moved down. In case now we make an up move into averaging, I will have to move them back up. So this is starting to be a rather painful ordeal, all said and done. But yeah, once again, stop loss on this at about 25. Okay, I've moved down all of my calls to 17,800, and this is currently trading at 22, with the call having much higher extrinsic value than the put. So I have a stop loss of either of these expanding to 20. I currently, if they were to expire right now, they would both expire worthless. But since we're holding at 17,800, I'm going to be short this particular position. And the idea is if this expands to about 20, I have a limit order which is set to 25 that I will execute and get me out of the entire position. Okay, right now we are 1 minute into averaging. Both of them are trading about 8 rupees to 9 rupees each. Roughly there's 17 points in this straddle. And if either of them expands to 15, I will cut off that leg and roll that leg away to whatever is, for example, if the put expands to 15, I will roll that away to the 17,750 put. If the call expands to 15, I will roll that away to the 17,850 call. So otherwise, as much as this position can lose, I will let it lose. Ideally, I would not have wanted to come to a straddle position, which was exactly why I didn't do it earlier when the straddle was available for 30. But because I was forced into it, because the only other thing I could do is take off the risk on this put, I kind of decided to go with the second approach of, and 2 minutes into averaging, holding at 17,800 is quite huge. There is a good chance that we have a picture perfect 17,800 finish, in which case this position out of 16.5 points that it's trading at now can give up all of that, which is quite good. I mean, I don't know if you've been following me for a while, but I used to take trades like this when my sizing was smaller, when it was around 10,000. And that time I would take trades like this because I could control them very easily. And yeah, there were times when I would capture 30, 40, 50 points in an expiry, but you can only do that when your capital is very small. You can't do it with larger capital. This call has an intrinsic value currently of 4 or 5. It's trading at 12.5. So anyway, we'll have to monitor this position. I will keep you posted. Okay, my stop loss is getting hit, so I will just be cutting out of this particular position. I hope I'm not buying it back at a, okay, I am buying it back at a ridiculous price, but that's the risk you take when you try to straddle into the expiry itself. Okay, so yeah, stop loss on the call got hit, could not do much about it. Whatever remaining is there in this position, it will continue to give up. So
all said and done, I should be gaining 2 points from here. So it will be a cost to cost expiry. And I think that's fine. It would have been basically impossible to handle this particular day if I didn't take the steps that I did. I think one major issue that I do have is execution. If I'm trying to take such tight trades with a very large capital, it becomes really difficult to manage the swings, right? So like you can't sit on a straddle which is worth 16, 17 points and then expect that you'll be able to get out of 40,000 sizing in a heartbeat. It's not going to be possible. Okay, we are almost done with averaging. These two more or less are going to expire definitely worthless. This is also going to expire worthless. Effectively, I'll be gaining about 28 paisa, and after charges, I think today is more or less going to count as a break even. My charges will be about 15,000 or so, and I think that's more or less how much profit I'll be making. So one thing I did in averaging is I got rid of some of my puts, and when the calls expanded till about 1.5 due to an up move, I actually shorted more of the 17,850 calls. Let me go over why I did that, and I'll try to be a little more thorough in explaining how. So here you can see these calls really spiked for some reason to 2.7. Of course, I placed my order then, and by the time my order executes, it always executes at 1.95 paisa, 1 rupee 20 paisa, stuff like that. So what exactly is averaging? Every video I explain it, but I think I leave some gaps, which is why people invariably after that they want more clarity. The settlement price of any contract, be it a future, be it an option, will be basis the average settlement price of Nifty in the last 30 minutes. Now, what does that mean? Every tick you can see what Nifty is. Nifty is 17,820.55, 17,822.6, right? 20.6, 19.4. So every tick of Nifty that is there in the period of the last 30 minutes, you do a total summation of that, right? And then you divide by the number of ticks that were there. That will give you what is the average price of Nifty. What is the average price in which it traded in the last 30 minutes, and that will count against the settlement of options. For example, in the last second, let us say there's some huge buy order that is placed which pushes Nifty to 18,000, hypothetically makes a 180 point up move in the last 1 second. That does not mean that all call options below that 18,000 are in the money. No, if the average price, once you have done taken a calculator, added all the number of ticks and then divided by number of ticks, if that average price is holding above 18,000, which will be impossible if it happens in 1 second. There are thousands of other ticks, right? Even if you assume 1 tick in every second, that gives you almost 18,000 ticks. So out of 18,000 ticks, if one of them has an anomaly of being 180 points higher, it doesn't really matter. Now, how do you take advantage of this? When I shorted this 17,850 call option again, the 17,850 put option price is what I'm looking at. That was trading at about 22. Now, if this call option, which is now expanded to 2 rupees, has to go to has to have any value by the end, then that 20 rupees, 22 rupees that is there in the put option has to go to 0. So that is highly improbable, and it requires a big move above that particular strike and then requires you to hold there. So you can understand if the average is below a particular strike, 17,850, the average is below. And there is a move above 17,850, then you have to hold above 17,850 for the same amount of time and same amount of average distance that is there based on what is the current average and that strike. So let's say, to simplify it, if the average was 17,820 and we immediately made an up move, we have to hold at 17,880 for the same amount of time for the average to be pulled over 17,850. Just like weighted average, I think if you Google it, you'll find everything you need about weighted average. I'm sure NSE also has a document somewhere as to how this whole thing works, and that should give you a clearer picture. So more or less, this is done. Now I need to take a look at my Larsen and Reliance position. Okay, one more thing that I've done is I've sold Larsen 1800 put option. Basically, what this will do is this will cover some more of my potential upside risk on my particular Larsen position. Not sure why this is showing a loss. We are definitely booking a profit on the position, all said and done.
And yeah, let me just go over my Larsen position. So initially this was a covered call where I had sold my call at 1700, where Larsen was trading at 1570, 80 or something. That 1700 call went in the money, and to deal with that, I sold a bullish triangle where I sold the 1740 put and the 1760 call. My entire, obviously the bullish triangle itself has paid off because now this call is in the money. And that's the kind of move that Larsen has made today, almost 3.6, 3.7% move. And now I have sold these put options to further cut off risk on the upside. The thing is, I don't have that much upside risk on this position because my shares, about 1200 shares, have benefited. How much is that? Like a good 200 points. So that is 2.4 lakh profit on my shares, whereas this particular position is losing me 44,000 rupees. And these put options will, in case there's a kind of a big up move tomorrow, that will protect me against it. Rest I will see. Reliance, I will wait. My Reliance position, I have my shares which are in profit, and I have this particular position which is also making me money despite the continued up move. It was making me, as of yesterday, about 1 lakh, but because of this up move, I've kind of gotten screwed here. I will wait and see what happens tomorrow and accordingly make adjustments to it. Once again, here Reliance, my shares have benefited by a good 350 points. 350 points, and I'm holding shares of Reliance about, I think once again here also around 1200 shares of Reliance is what I'm holding. So it's a very good profit on the shares, but this position's bleeding, so we'll see. The rest of it, this is going to expire now. It's done, so we will call it break-even day, slightly positive. Thank you so much for watching. I hope you had a good trading day. I hope you didn't get messed up by this kind of a move, 2.3% and 1.6%. Bank Nifty and Nifty. Kind of ridiculous. So thank you so much for watching. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.